Historically, in an asset allocation context, income has always come from the bond side of the total portfolio. That's becoming a challenge today as bond yields across a number of different countries have fallen so close to zero that the real yield is often negative. So if you're looking for income, you really need to move outside of bonds and look elsewhere. And I think within the equity space, that's starting to look more and more like the more attractive option for investors. A lot of investors are hunting for yields, and the result of that is you can sometimes become too aggressive in that pursuit for yield, meaning having very concentrated weights into a few high yield names when the high yielding names are actually a representation of distress, of future decline in dividends, or even future negative price returns. The FTSE RAFI Equity Income is created by starting with the universe of high-yielding equity shares, and then keeping those that are high quality. By that I mean stocks that have a sustainable income over time, stocks that are not distressed, so would not have the risk of cutting dividends or meaningful negative price appreciation, and also in stocks that have growth potential, so there's even an upside to the increase in income over time. And so selecting high income stocks, controlling for those that have positive quality characteristics, and then weighting these stocks by a fundamental anchor so that you have a representative, liquid, easy to trade portfolio. Whether it's the FTSE RAFI Fundamental Index, the FTSE RAFI Low Vol, and now the FTSE RAFI Equity Income, they give investors different risk-return characteristics and different exposure. For investors who are looking for just a core allocation, the FTSE RAFI Fundamental, I think, is the right choice. It has the lowest turnover, highest capacity, and captures largely, I think, the features that people look for in a smart beta solution. But certainly, different investors are going to seek different risk or different return objectives. For investors that really care about de-risking their equity allocation, I can imagine they'll want a lot more equity allocation to the FTSE RAFI Low Vol. Whereas for investors who are really seeking to build duration, to build income yield in their portfolio, they're going to really favor a FTSE RAFI Equity Income. Now, all investors are different. They're looking to solve different problems. By having these different components, this allows them to really customize for themselves a smart beta solution that could either target tracking error, volatility, income, either together or separately.